Welcome to this comprehensive guide on the Irrevocable Life Insurance Trust, which is a cornerstone of advanced estate planning, often referred to as an ILIT. As we navigate the financial landscape of 2026, high net worth individuals are facing a unique set of challenges and opportunities when it comes to preserving their legacy. With the federal estate tax exemption currently sitting at approximately $15 million per individual, many families might feel a false sense of security. However, for those whose assets exceed these limits, or for those who want to ensure maximum liquidity for their heirs, the ILIT remains an essential tool for shielding millions of dollars from the 40% federal estate tax. To understand the power of an ILIT, we must first address a common misconception regarding life insurance. Many people believe that life insurance proceeds are always tax-free. While it is true that beneficiaries generally do not pay income tax on the death benefit, the Internal Revenue Service includes the full value of the death benefit in your gross estate if you have any incidents of ownership in the policy at the time of your death. This means if you own a $10 million policy in your own name, that entire amount is added to your other assets like real estate and investments when calculating estate taxes. At a 40% tax rate, your family could lose $4 million of that insurance payout directly to the government before they ever receive a dime. An irrevocable life insurance trust is designed specifically to solve this problem by taking ownership of the policy out of your hands and placing it into a legal structure that is not considered part of your taxable estate. The process begins with the creation of the trust document, which must be drafted by an experienced estate planning attorney to ensure it complies with the latest FERS regulations. Because the trust is irrevocable, you cannot change its terms or dissolve it once it is established, which is the trade-off for the massive tax savings it provides. You will appoint a trustee, who can be a trusted friend, a professional advisor, or a corporate entity, but importantly, it cannot be you. The trustee is responsible for managing the trust, paying the insurance premiums, and eventually distributing the proceeds to your beneficiaries according to your specific instructions. When the trust is created, the trustee applies for a life insurance policy on your life, or you can transfer an existing policy into the trust. However, you must be aware of the 3-year rule, which states that if you transfer an existing policy and pass away within 3 years of that transfer, the proceeds will still be included in your taxable estate. For this reason, many advisors recommend starting with a new policy owned by the trust from day one. Funding the ILIT is where the strategy becomes highly technical. Since the trust owns the policy, it must have the funds to pay the annual premiums. You provide these funds by making gifts to the trust. However, these gifts would normally be considered a future interest and would not qualify for the annual gift tax exclusion, which in 2026 stands at $19,000 per recipient. To circumvent this, estate planners use what are known as crummy powers. When you make a gift to the trust, the trustee sends a formal notice, called a crummy letter, to the beneficiaries, giving them a limited window of time, usually 30 days, to withdraw their share of the gift. While the beneficiaries rarely exercise this right because they understand the long-term goal of the trust, the mere existence of the right to withdraw turns the gift into a present interest. This allows you to use your annual gift tax exclusions to fund the insurance premiums without dipping into your $15 million lifetime exemption. For a married couple with several children and grandchildren, this can allow for hundreds of thousands of dollars in annual premiums to be paid completely tax-free. One of the greatest advantages of an ILIT is the immediate liquidity it provides upon your passing. Estate taxes are typically due within 9 months of death, and the IRS requires payment in cash. If your wealth is tied up in illiquid assets like a family business, a farm, or a large real estate portfolio, your heirs might be forced to sell those assets at a significant discount just to cover the tax bill. The ILIT provides a pool of cash that is available immediately. While the trust cannot be legally required to pay your estate taxes directly, the trustee can use the insurance proceeds to purchase assets from your estate or provide loans to the estate, giving your heirs the cash they need to pay the taxes while keeping the family assets intact. This ensures that your business or property can continue to grow for future generations, rather than being liquidated under pressure. Beyond tax savings and liquidity, the ILIT offers a high degree of control and protection. Because the assets are held within a trust, they are generally shielded from the creditors of both the grantor and the beneficiaries. This means that even if a beneficiary faces a lawsuit or a divorce, the insurance proceeds held in the trust are protected. Furthermore, you can use the trust document to dictate exactly how and when the money is distributed. You might choose to have the funds released in stages as children reach certain ages, or you can keep the money in the trust for the beneficiary's entire lifetime to provide a steady stream of income while protecting the principal. This level of customization allows you to guide your family's financial future long after you are gone, ensuring that the wealth is used responsibly and in accordance with your values. In 2026, the role of life insurance in estate planning has become even more critical as families look for ways to lock in the current high exemption levels before they are scheduled to sunset. While the $15 million exemption is generous, it is always subject to political change, and the ILIT provides a permanent fence around a portion of your wealth that cannot be touched by future tax hikes. It is also an excellent tool for balancing an estate. For example, if you have one child who is involved in the family business and another who is not, you can leave the business to the first child and use the tax-free life insurance proceeds in the ILIT to provide an equal inheritance for the second child. This prevents family friction and ensures that everyone is treated fairly without needing to break up a successful company. In conclusion, the Irrevocable Life Insurance Trust is a sophisticated and powerful vehicle for any individual with a significant net worth. It effectively removes a major asset from the reach of the estate tax, provides the necessary cash to settle other tax liabilities, and offers unparalleled protection for your beneficiaries. While the rules surrounding crummy notices, incidents of ownership, and the 3-year rule are complex and require